See, Nick, you're here bright and early. How's it going, Crossfire? Nick, I notice who shows up and who doesn't. Glad to see you here again. One of the first. Anthony, how's it going? Mr. Clean, nice to see you here. Weezoot, welcome. We're going to start at 4:30. I just figured I'd send the link in, drop early. How's it going, Centroids? All right, 2 minutes and we will begin. One more minute. Oh, did it just show us? Yes. That was me and my wife. All right, here we go. So let's start with going over Voex for spot specifically. Now, this is more of a continuation from yesterday's lesson, and once we finish up with Voex, that's when we'll get into the snap graphs. So I picked spot because it's just such a super interesting Voex, and there's so much we can take out of it. So I think this would be a good real life example for those of you who are trying to figure out how to trade with Voex. So let's start over here. We can see on January 20th, Voex and Voex trend started to move into the inhibition zone. And then you can see for the remainder of the entire time period since January, Voex has been in the inhibition zone. So we said January 20th. Let's go to spot here. And we see that on January 20th, price actually gapped up over the weekly trigger. And shortly afterwards, the next day, the hourly trigger crossed above the weekly trigger. Then the daily trigger crossed above, and price just rode the daily trigger higher all the way till the monthly trigger. Bumped its head against there, but then we can see the hourly trigger crossing above, and the daily trigger then crossing above, and price continuing to rip to the upside. Now, this move here was a 91% move to the upside, which is, if you took, let's see, back here, price is at 94. If you took any kind of long-term call position at that time, of course, you would have made tons of money. So we can see general idea here and what happens when Voex trend moves into the inhibition zone and then stays there. not every single day was the price action green. In fact, there was a 1, 2, 3, 4, 5-day pullback here. There was a 1, 2, 3, 4-day pullback here. There was plenty of red days, but overall, throughout the entire time period, the Voex trend remained in the inhibition zone. We can clearly see that there was bullish price action. And so the way you can structure a trade using Voex is once you see Voex trend move into the inhibition zone, as long as, Voex doesn't get all spiky and crazy like it actually kind of did here in the beginning, it pretty much now becomes bullish until proven otherwise. And wouldn't anyone want to hold a stock that's under the category of bullish until proven otherwise? Meaning, as long as Voex trend does not move back down into the stability zone, or as long as Voex itself does not move back down into the propagation zone, we have to be assuming bullish price action will continue until proven otherwise. Proven otherwise would be Voex trend moving back into stability. So this is just a pretty textbook example of how we can use Voex behaviors to stay in positions for a term, for a longer term, like a year or 6 months, instead of the active day trading that we're all used to here. So the plan eventually, after the bootcamp ends, is to pay deep dive stocks for limited data. We won't have access to every stock because he's not accepting any new members, but we could have access to, for example, the 8 stocks that we have on Meme Stock Watch, and then let's say an additional 10, 20 stocks. Now, if you have Voex graphs and obviously the rest of the PDFs for 20 stocks or so, shouldn't be too hard to skim through them every single night and find a trade all on your own. In fact, you should be able to find at least 3 or 4 every single day. And so it'll be a constant cycle of just checking Voex at night, understanding exactly what Voex is telling you, not needing anybody's help, nobody's help, not Twitter, not Reddit, not me, only Gavin for levels, but just viewing a Voex graph like this one and easily being able to enter a position based off what you see on Voex, based on understanding it. I see a question, is there a way to use Voex for free? No, Voex is part of Deep Dive Stocks, which I'm a member of. All right, so also I just want to note, it is very interesting that price broke above the weekly trigger on the day that Voex moved into the inhibition zone. Let's move on to Palantir now. All right, so Palantir's Voex moved into the inhibition zone on May 10th. And we're just going to go check out Palantir here on our charts on May 10th. It's not what I meant to do. All right. May 9th, price, broke above the weekly trigger. And this is a strikingly similar setup to spot that we just saw. Price breaks above the weekly trigger, then the hourly and the daily does. Then price moves above the monthly trigger, then the daily does. And this entire time, price exploded to the upside. And so when we look at spot, when Voex trend moved into inhibition here, but came back down, and we can see that was followed by bearish price action. But over here, Voex trend moved into the inhibition zone and stayed there. And as long as Voex trend was in the inhibition zone, not every single day was green, but from when Voex trend moved into the inhibition zone until today, so we go to May 10th, that's a 92% move to the upside. Now again, options from $9 to $18 in the span of May, June, July, obviously that's a hefty amount of profit. So again, another textbook example how we can use the Voex graphs to see, whether Voex is telling us that the stock is bullish or not. And once we have that data, we don't have to fret over the day-to-day action, the minute-to-minute action. We don't have to watch it on a 1-minute chart. If we understand that Voex trend is in the inhibition zone, then that means that the stock will continue to move higher until proven otherwise, which means until either Voex cracks into the propagation zone or Voex trend moves back into stability. Now, there could be, a short-term downside and Voex moves into the stability zone. That is also, indicative of short-term downside, but Voex can easily repair itself and move back into the inhibition zone before it stays in stability long enough for Voex trend to come down. Now, Voex trend, I believe, is just the 5-day running average of Voex. So once Voex trend moves into the inhibition zone, it's basically telling you that Voex has stayed in the inhibition zone long enough to have a presence there. This is kind of like it jumped in, but then came right back out. Jumped in, came right back out. When Voex trend moves inside, that means, okay, now it's establishing more of a presence here, and that could signify a huge rally to come, like we see here, Voex and Voex trend moving into inhibition, and price in general moving on a very strong uptrend. So again, in this instance, once we see the Voex trend move into the inhibition zone, it's not that hard to just sit in a long-term position and just continuously check Voex every single night. Now, we can also trade this on our own, hedging for downside when prices below the hourly trigger by selling credit spreads, by selling debit spreads, or by, which will be explained later in the bootcamp, or by buying puts once price moves below the hourly trigger. But it would be fairly easy to hold a long-term position the entire time the Voex trend is in the inhibition zone. Let's move on now to BABA, just to give, kind of an opposite example. All right, so now that we have BABA here, we're going to take a look at, kind of Voex behaviors over the course of this entire move. And I'm just going to, I want to specifically pinpoint here and here and here. And I want to see if anybody in the chat can, let me know what I'm looking at. So once again, that is here and here. Yeah, just those two. Voex spikes. Okay. Anybody else want to give it a go? Those watching a little later on, before skipping the next minute or so, why don't you try to, on your own, see if you can understand what I'm trying to point out in these two instances. So from the inhibition zone back into stability zone, bullish move, Voex daily with Voex trend before a rally. Okay, so what I'm trying to point out here is Voex trend right here moves into the inhibition zone. And initially, that's considered bullish, although with the understanding that eventually when Voex trend moves back into stability, a lot of those gains will be lost. And so, yes, price action is being worked against. So even if it's bullish, we have to know in the back of our minds that price action is being worked against. So Voex trend moves into inhibition here, and price continues to slowly or not so slowly climb to the upside until right here. Then we can see Voex starting to come down a bit. Right about in this area. And we can see once Voex trend move back into the stability zone, we can see pretty severe downside from $95 down to $81. Then again, Voex trend moves back into the inhibition zone here. And at that time, price is about 83, and price is able to move all the way up to $102. Yes, there was a Voex spike right here, which shows a little bit of, extreme amounts of price being worked against. So, really dangerous. And shortly after, price starts to fall. But once Voex trend and Voex moves back into stability, that's when the bulk of the downward price action happens. Voex bounces off the propagation line here and comes back higher. Voex trend moves into the inhibition zone, and price is able to have some nice upside. Then it gets really spiky over here, followed by downside. But even though it's followed by downside, we can see, and even though Voex itself moved into the stability zone, Voex trend never moved into stability. And so that's why it was pretty shortly followed by a nice upside move, but spiked right here, showing that price action is really, really being worked against. And that was followed from a move back down from 96 to 93 or so, and very possible still a little bit more downside until, Voex kind of stabilize here. However, the point is that the Voex trend is now deep, deep inside the inhibition zone. And what you'll notice from spot and Palantir, when Voex gets really deep in the inhibition zone, it takes a lot of Voex moving down to bring Voex trend back into stability. So when Voex trend moves really high into the inhibition zone, it would take Voex moving down for quite a while to bring Voex trend all the way back into stability. Now we can see here, once Voex trend escapes a little bit, too far into inhibition, it kind of ends up leading to extreme price movements, extreme price rallies, because it's hard to get Voex trend all the way back into stability. We can see the same thing with Palantir, where Voex trend just gets such a deep move into the inhibition that even when Voex comes down, it would need to stay down here for 5 days or more to get Voex trend actually back into stability. So once Voex makes a super high move to the upside, even if it gets spiky and is followed by short-term downside, the trend is now bullish until proven otherwise. If we go back to BABA now that Voex trend is all the way up here in the inhibition zone, who can tell me in the comments what we would expect to happen moving forward? I see Centroids is already all over it. Good job. So I guess the summary of the question is, what would you suggest the data is trying to tell us right now? Or what price interpretation can we take out from the data? Yeah, so it looks like everybody got it. It seems to be from this Voex behavior that price will now, move to the upside. Bullish AF, as Mr. Clean says. Now, this is when I finally bring in the snap graphs. And, I worked really hard on the snap graphs introduction, how I'm going to set it up. So I hope you appreciate how I set this up. But is this telling us that price is expected to move to the upside now? Is this Voex print, the fact that Voex trend so high in the inhibition zone, is that really telling us to expect upside or not? For that, we will move down to the snap graphs. This is the introduction to the snap graphs. And before I go into how we'll explain it with what it has to do with BABA, I'm going to give everybody some facts about the snap graphs. So the snap graphs help interpret Voex in relation to future price action. If you want to write that down, that would probably be a good note to take and understand. One more time, the snap graphs help interpret Voex in relation to future price action. The snap graphs are calculating 3 years of previous Voex data to give a price prediction for the future. One more time, the snap graphs are calculating 3 years of previous Voex data to give, a price prediction for the future. Now, the snap graphs, had a lot of back testing done on them, and the 20-day snap graphs over the past 5 years were correct 78% of the time. The 10-day snap graphs were correct 75% of the time. The 5-day snap graphs were correct 76% of the time. And the 1-day snap graphs were correct 68% of the time. The closer snap graphs are more reactive, so they have a less chance of being correct, but still well over 60%. And if you're hitting over 60% in trading, you're going to have a nice growing portfolio. When all snap graphs are saying the same thing, it's already enough just based on statistics for a small size bet that wouldn't need to be monitored daily, except for a nightly checkup on the 10 and 20-day snap graphs. So I hope that made sense to everybody. I'll go over it one more time quickly. The 20-day snap graphs are 78% of the time correct. 10-day snap graphs are 75% of the time correct, 76% of the time correct, and 68% of the time correct. All right, so now let's move on to the snap graphs for BABA. So we notice a extreme Voex spike that happens right here. And, when Voex gets too spiky, what follows? Short-term downside. You can see it here. Voex got too spiky, short-term downside. We can see here, Voex got too spiky, short-term downside. You can see here, Voex got too spiky. What would we expect? Short-term downside. What do the snap graphs tell us? The snap graphs tells us that based on the past 3 years of Voex data for BABA specifically, the 1 day we should expect bearish price action. 5 day we can expect bearish price action. The 10 day we can expect bearish bearish. Wow, that's a tongue twister. Bearish price action, but the 20-day is bullish. Now, can anyone tell me why the closer dated snap graphs would be bearish and the 20-day snap graphs would be bullish? What is the snap graph seeing in Voex? So I'll give you guys, a couple of seconds to think about it. So in my opinion, what the snap graphs are saying is pretty much exactly what we can see for ourselves, but with added confirmation. We know that this was a pretty nasty Voex spike, and it shows that this move is greatly being worked against. Sure enough, we already started the pullback, but the snap graph suggests that this spike is going to cause short-term downside over the next 1, 5, and 10 days. However, because the 20-day snap graph is bullish, I'll say it exactly like Nick said in the chat, short-term instability and long-term upside. Even with this pullback over the next 10 days that the snap graphs are calling for, or 1 or 5 days, obviously things can switch at any moment. But for now, that's how the snap graphs are interpreting Voex. Even if price comes down, the snap graphs don't feel like it will be enough downside or Voex moving down enough for Voex trend to move back into the stability zone. And so even with future downside on its way, the snap graphs still think that because Voex trend is this deep in the inhibition zone, it will shortly be continued by future upside. So I hope that made sense. And, really that's the whole idea of the snap graphs. It is our job always to try to interpret Voex as we see fit, but the snap graphs are going to do an excellent job, as always, in showing how, how the snap graphs would interpret the current Voex that we have based on 3 years of prior information. So for that, I'll stop here and answer any questions that you guys might have in the chat, and we'll continue at like F4:52. So 3 minutes for any questions based on what we just covered, and then we're going to continue. Can you go back over how you're reading the snap graphs real quick? Yes, I probably should have started with that. Thank you. So crosshairs below the gold line is bearish, crosshairs above the gold line is bullish, and that's all you need to know. Can we make assumptions on where Voex may lead based on the 20-day snap graphs alone? Yeah, I mean, the 20-day snap graph is bullish. It seems to be saying that it's bullish because Voex trend is going to be able to remain in the inhibition zone, signaling bullish price action. What are the pink dots? Not important, but I can link the LDPM primer, which is right here. Not the LDPM primer, the snap graphs primer. Guess it's not here right now. Here. So above would be bullish, below would be bearish. 10-day forecast. So the shaded area is 68% confidence interval where price will be. Shows the relationship between Voex and future price. But again, you don't have to pay super deep attention to everything else that's going on the chart. The only thing that I would recommend paying attention to is just if the crosshairs are above or below price. So Aaron asks, so spikes are a short-term bearish outlook. So we said this yesterday in the stream. Voex spike is usually provoked by excessive movements. It indicates extreme resistance and usually resolves in the downside, usually short term. So this really lines up exactly with what the snap graphs are telling us. It's a Voex spike, so I'd be near term bearish, but long term, the snap graphs are expecting Voex trend to be able to remain in the inhibition zone, which could lead to bullish price action in the future. So knowing what we now know with BABA, let's jump into the charts and see how we may want to trade this. So again, here's where the Voex spike happened and was shortly followed by downside. monthly trigger is above at 116.88, and it looks like the daily trigger is pretty close to crossing. Answer one more question. Does the degree to which the crosshairs are above or below the gold line matter in terms of expected price action? Crosshairs further above below gold line indication of more volatile moves? Excellent question. I do believe so, yes. I do believe it is based on a confidence interval. But most important is, are the crosshairs below or above the gold line? So for BABA, this is a pretty textbook setup for BABA to move up to the monthly trigger. Now, if I ask you guys, based on Voex trend being in the inhibition zone, does Voex seem to agree or disagree with the viewpoint that BABA can now move up to its monthly trigger? I'll let you guys try to answer that in the chat. Wes out. What's your Discord username, by the way? Just curious. Okay. So, okay. Yeah, great job. Fantastic answer. So it does seem that there's a great possibility that we can see something like this happen, where price maybe moves down, range bound a bit, and then airplanes off the hourly trigger, which would in turn help the daily trigger finally cross above. So for now, knowing what we know with Voex, with the snap graphs, it's very possible that if tomorrow price goes up or down, the closer dated snap graphs will change their opinion and maybe be bullish. But we know that right now the longer term outlook is bullish because of Voex trend being in the inhibition zone. So how I would structure a long-term trade here was, I would keep waiting day by day until the Voex one day looks bullish or until price can get back above the hourly trigger. And then more than likely I would take the position to this monthly trigger. Now, this entire trade, instead of watching minute by minute, day by day, second by second, watching my portfolio, the position in my portfolio going up or down, giving me heartache, giving me euphoria, swings of emotions up and down, my mentality is my price target is 116. Right now, I know that Voex trend is in the inhibition zone, and as we just saw with Spot and Palantir, that can lead to 100% moves to the upside. I know this is a huge air pocket, and I know that once the daily trigger crosses above the weekly trigger, there's statistically probable that price can now make a move up to the monthly trigger, just like we saw in Spot, where the hourly trigger and the daily trigger crossed above the weekly trigger, which led to price attacking the monthly trigger. And this was also a pretty big air pocket. This was a 57% air pocket. We also saw it in Palantir, where the hourly and the daily trigger crossed above the weekly trigger, and Palantir moved to the upside 81% to fill the air pocket. So for BABA, there's no specific reason why price would not be able to make a 30% move up to its monthly trigger with the same Voex trend in the same inhibition zone. So for me personally, when I take a look at this setup, I'm really comfortable with my risk reward, knowing that Voex trend is in the inhibition zone. I can use the daily trigger, the weekly trigger, or the hourly trigger as my stop loss. And when I would be ready to enter this position, if I would, for example, enter today, I am risking 28% reward to 3% risk to be stopped out. And so to me, when I have 3 to 28 risk to reward ratio, whether the trade works or not, that's something that I always have to be comfortable with taking the trade. And in this specific instance, I would be comfortable taking the trade. And so for BABA, what we'd probably want to look out for is maybe a massive amounts of sold puts, which we don't really see right now, or maybe the 1 day, 5 day, and the 10-day snap graphs start to flip their opinion. And just in general, a nice little reset of Voex. But the end point is that because Voex is so deep in the inhibition zone, at this point in time, our expectation should be that price will move up and attack this monthly trigger. So again, very possible that we may have some short-term bearish action, but the goal of that is to use the small pullback, or the pullback that the snap graphs and Voex are suggesting, as a buy rather than a sell with a stop loss below. So Eric asks, when you say use X trigger as a stop loss, how does that calculate to options, which are priced differently than the asset? Would it be a straight division of price by 100? So it's a great question. What I personally mean when I say use a stop loss below a trigger is I will go like this. I'll set an alert under the trigger, and if my alert gets hit, I look at the chart for a second and then I sell the position. Another way you can do is if, for example, if I'm using the weekly trigger here, let's make this even better. If I'm using the 5-minute trigger as a stop loss and I buy on this green bar, 1-minute candle close above the 5-minute trigger, and I buy my option for 0.90, for example, $2 or $1 out the money, then immediately after buying the option, I'll immediately set the stop price at 0.80, because I know if price moves back down below the 5-minute trigger by 10 cents or so and closes a candle below, I'll get stopped out. So it's pretty simple math. Another thing you can do is just take the delta of your contract. So if you're buying price at 91, if you're buying a $92 call, you may have 0.75 delta, which means that every dollar price moves higher, your contract price will move up 0.75 cents. And so when you know that, okay, my delta is 0.75, which means that if price moves down 10 cents, then my contract will move down, let's say 7 cents. And that can help you easily do the math on your own for placing a stop loss. But in general, if I get to take a position right above a trigger, then I'll just set the stop loss right away under the trigger. Or for example, if I'm buying here right now and I decide that my stop loss is going to be the weekly trigger, then I'll just set an alert like this and I'll stop out if that alert gets hit. What if price loses the daily trigger and later recaptures it? Would that be a spot to get in as well? Sure. I mean, price losing the daily trigger would be a pretty nasty bear plane, but it wouldn't be confirmed until the hourly trigger comes back through as well. And so, there's really a couple of options here. I think the best way for me personally would be to wait until price moves back above the hourly trigger to get long again, or to wait for a downside move or to wait for a downside. I feel bad for everyone watching that later. They're all going to get scared. Or I'd wait for price to come down to the weekly trigger. That night, I'd check the snap graphs and see if anything changes, or I'd wait for price to move all the way down to the daily trigger, check the snap graphs at night, and see if they're starting to turn a little bit more bullish. So that is the explanation of snap graphs and the continued explanation of Voex, and we're all done on that aspect. Again, it would help to review the cheat sheet if you want to screenshot it here, or it's already in the daily videos section, so you don't really have to. And then you can screenshot this as well to read on your own if you want to understand snap graphs a little bit deeper. Now, we're going to talk about something called debit spreads and credit spreads for the next 10 minutes, because this is a very important part of trading, and a lot of people don't utilize it either at all or don't understand exactly how they work. So I'm going to get into debit spreads right here. I'm going to use an example of, let's say, PayPal. Okay. So let's say PayPal broke above the weekly trigger here. And in my mind, I'm thinking a couple of things. All right. Either one, PayPal is going to chop until the hourly trigger crosses, and then it's going to explode higher. Two, PayPal is going to break above the weekly trigger and explode higher. And three, PayPal is going to break above the weekly trigger and then come right back down below. So it's very difficult to trade that with just, one directional trade, which means I'm just long calls, because, first of all, you may just lose on theta until the hourly trigger comes up to cross the weekly trigger if price is just chopping. And two, you may lose if price moves above the weekly trigger and back down below the hourly trigger. So here's where debit spreads come in. So PayPal crosses the weekly trigger right here at 72. Now, if I want to get long because I'm scared that I might miss an explosive move to the upside, which in this case you would have missed a $1.50 move to the upside before the hourly trigger crossed. If I want to get long but I want to mitigate the risk of price possibly breaking above the weekly trigger and breaking back down, or price just doing nothing throughout this entire time period, what I'll do is I'll, let's say, buy the $80 call for September and sell the $85 call. Let's just use these numbers just for, for educational purpose. We'll just say the $85 C, the $85 call is $150, and the ADC will do $200. September calls. All right. Now, again, I think that this could potentially be an explosive upside move, price breaking above the weekly trigger. And so I want to buy, and I don't want to wait for the hourly trigger to cross above. Let's say the data is bullish, or there's sold puts, or Voex is bullish, etc. It doesn't really make a difference. The idea here is to buy the $200 call and sell the $150 call. Now, here's what could happen. Either price can continue to the upside like it did here, and you'll make money, but you won't make as much money as if you didn't sell the $85 call because it's a spread. But at the end of the day, profit is profit, and you'll be making money on this entire move higher. Second option that can happen is that price breaks above the weekly trigger and just stagnates sideways until the hourly trigger crosses. If that happens, then when, let's just say price kept, or let's just say this green line is where the hourly trigger crossed above and not here. As soon as the hourly trigger crosses above, move it to drop. As soon as the hourly trigger crosses above, I can then buy back the $85 call that I sold for a little cheaper than I bought it, than I sold it for, sorry. Again, buying the $80 call and selling the $85 call. You can do this on any margin account. So as time moves on, both of these are losing a little bit of value, but when the hourly trigger finally crosses, I close the hedge, meaning I buy back these calls here, and then let's say, for example, now they're going to be only 130. Whoops. So I profited $20 on each call that I sold, and the $200 calls are going to be, now they're going to be 170. So these lost $20 in value, these lost $30 in value. However, now that the hourly trigger crossed, as soon as this starts moving higher, this is already back up to 200 and even more, and we're able to profit off of this one, okay? So now let's talk about the third scenario. Third scenario is that price breaks above the weekly trigger, comes right back down, but ends up, comes back to the hourly trigger and bounces and continues moving higher. If that happens, then I can buy back the sold $85 call at the hourly trigger. Let's say I buy the $80 call when price breaks above, and I sell the $85 call. Let's just keep these numbers, 170 and 130. If price rejects and comes back down here, I can then buy this back for 100. And I profited $30 per call. Now, this comes down also, and this comes down to, let's just say, 135. All right, so this lost $30 in value. This loss will do $40 in value. Per contract. Okay, now I buy these back and I profited $30 per call. So let's just start from the beginning. Let's say we're dealing with one contract. Let's say we're dealing with 10 contracts. So I'm down 400 on this one, but when price comes back down here and I buy these back, I'm now up $30 each on this one. Then I can add that profit to this position, average in a little bit at the hourly trigger, and then get that nice bounce. And if that either breaks above the weekly trigger or stops at the weekly trigger, at least you get a nice bounce, and now you're in profit on these, and you made profit on these, especially because you're able to add back at the hourly trigger. So debit spreads are essentially a great way to minimize downside risk before trigger signal gives confirmation, while still being able to capture upside price action. So let's go over the three scenarios that could have happened one more time. Price breaks above the hourly trigger, the weekly trigger wouldn't know anything that's going to happen in the future. So pretend we can't see any of this. I don't know how to use the replay function, but pretend this is all we can see. All right, here's where price is. Price breaks above the weekly trigger, and I'm thinking, holy cow, look at this huge air pocket to the monthly trigger. Price might explode higher, and I'm gonna miss it. But if I just buy naked calls here, if I just go long here, price can also reject and come right back down. I'll be sitting in a huge loss before the play even started. So what I'll do is I'll buy the $80 call and I'll sell the $85 call here. If price continues marching to the upside, no problem. I'm making money on the way up. Sounds great. Everything's good. If price goes sideways and both contracts lose in theta, but eventually the hourly trigger crosses above, then I can cut the hedge. I can buy back the $85 calls for cheaper once the hourly trigger crosses above. If price rejects the weekly trigger and comes back down to the hourly trigger, I can then buy back the sold 85s for cheaper, add back to my bought 180s, and then continue to ride the move higher, while at the same time having a stop loss right below the hourly trigger. So instead of losing from 170 to 130, what the $80 calls are worth here, you're actually only losing $10 instead of $40 because the $85 calls that you sold are also losing $30 in value, while the $80 calls that you bought lost $40 in value. And so down here, if price comes back to the hourly trigger, you can buy back the sold 85s for a profit and then double down on your 80s. If price breaks below the hourly trigger, you cut the whole trade, but only for a 10% loss as opposed to the 30% loss if you just bought the $80 calls and didn't sell the $85 calls. So yeah, that's how we can use debit spreads to make profit before trigger signal gives confirmation, how to enter a trade before trigger signal gives confirmation. Now I want to talk about credit spreads. So for SPY specifically, or for QQQ, but obviously for any other stock as well, you don't always have to go long, or you don't always have to go short. You can sell the contracts as well. So for SPY and QQQ, because you can sell 0-date contracts every day, you can have theta working on your side, which is a wonderful thing to have. And so for example, let's say this morning, I can't sell 5 puts on SPY unless I have 100 times, unless I have 45,000 times 5. Because if I sell a put over here and the put goes in the money, I could be assigned at 450 and I would have to purchase 100 shares at 450. But what I could do is I can sell a 450 put and I can buy the 448 put. So now if price goes all the way down to 448, then I lose the $200 difference between 450 and 448. But as long as price does not come back below 450, comes down here a little bit, then you'll be in a little bit of profit and a little bit of loss depending on theta. But in short, if price continues to the upside, the 450 put that you sold will lose all its value, and the 448 put that you bought will also lose all its value. However, you're selling the 450 call for $100 and you're buying the 448 call for $60, you could profit the $40 difference, because if both expire worthless, if SPY continues to push higher, both expire worthless, then you make the $40. So if you do that, if you sell 10 of them, then your max risk is going to be about, let's say $100 or $160 for each put credit spread. But you can, as long as price doesn't come all the way down to 448, you're not going to take a full loss on any of them. And so if we have extreme bullish data from SPY or Voex or whatever we're using, we don't have to necessarily buy calls and have theta being worked against us this entire time. We can simply just buy puts. For example, if let's say there was Voex divergence tonight, which would give us a bearish outlook for the upcoming days, or let's say there was a large Voex spike, which would give us a bearish outlook for the next coming days, or let's say Voex moved back into stability today from the inhibition zone, which would give us a bearish outlook. We don't have to buy puts when the trend is super bullish and completely fight the trend. Instead, we can sell the 455 call. We could buy let's say we sell the call for $100 and we buy the 457 call for $60. So if both expire worthless, we make $40. All right, obviously you can do this 10 times, make $400. The only way we would lose here is if SPY moves above 457 by expiration. Or moves above 455 by expiration, but the only way you would lose the full amount is if SPY moves above 457 by expiration. So for me personally, I don't always have the time necessarily to watch and track and scalp the market. Although I love doing it, most of my day I'm answering questions, I'm looking up plays, I'm monitoring a lot of things at once, a lot of the plays that, let's say, I alert, and I don't really have the brain power to also track the minute to minute and play 0-day calls. Usually on Fridays I'll do it and I have a lot of fun, make some money, but on a general day-to-day basis, I can't really spend time doing it. So I look at the data the night before and I look at the snap graphs, which already give me a 68% chance of winning the next day. And then as soon as market opens, I just sell the 0-day contracts. So, for example, meme stock watch, all the reports are bullish since here. This is when meme stock watch went full bull. I've just been selling puts, selling put spreads, like 10, 15, 5 put spreads. And every day, at the end of the day, I just keep the premium because they expire worthless. And I'm not busy with, trying to time tops and time pullbacks and all this kind of things and like watching LDPM every second. I'm just caring about LDPM on, let's say, the 1-hour chart. And so as long as price is above 1-hour LDPM and above the hourly trigger, I have no problem selling put spreads. And I don't have to watch every single minute of every single day. So for those of you that want to make money from the data but don't have the time to sit there trading every single day, learn more about credit spreads, learn a little bit more about debit spreads. If my explanation wasn't enough, you can try and learn by experience one at a time, or you can go on YouTube and look up additional videos, but you don't always have to have theta working against you. You can also have theta working for you. And again, you always have a max risk on put debit spreads, put credit spreads, or call credit spreads. Your max risk is always the difference between the call that you buy and the call that you sell, or the put that you sell and the put that you buy. So you can't really, lose unlimited value with it. You can only lose depending on how far you want to spread it. So for example, here, if I would have sold the 440 put and bought the 435 put, so that's a $5 difference. So I could have sold the puts for $500, a $400 put, let's say 2 weeks out. I could have sold it for $500 and bought a 435 put for only $100. So I'm making $400 as soon as I make the trade. Now, the problem is there's $5 worth of risk all the way to 435. So if price goes below 435, then I'm out $500, the difference between 450 and 435. But if price even moves, 439, 438, and then pops back up, I'm all safe because as price is moving down, my put contract that I bought, my 435 is also gaining in value, just like the 440 that I sold. So, depending on how confident you are, if I'm not super confident, then maybe I'd sell the 440 and buy the 439 so that my max loss is only $100. But if I'm a little bit more confident, then maybe I'll sell the 440 and I'll buy the 436. And now my max loss is, let's say, $400, but I'm making way more money as soon as I sell the contracts. Now, if I'm extremely confident that the market's going down tomorrow, maybe at open, I'll sell the 445 call and I'll buy the 449 call. If the market rips to the upside, then I'll be down, let's say $300-400. But if the market doesn't move over 455, I'll make a whole lot of money from selling the 455 call and only buying the 459 call, for example, or the 460 call. So just wanted to give over a brief explanation of put spreads, put credit spreads, put debit spreads, call credit spreads, and call debit spreads. The only thing we didn't talk about actually was put debit spreads. So what that is let's say right here, price is moving below the hourly trigger. I would buy the 433 put, for example, and I would sell the 431 put. So meaning the 431 put that I bought, the 433 put that I bought will now be cheaper because I'm also selling the 431 put. So again, it's really just a way to minimize risk while still being able to capture possible downside. And then, of course, if price moves back up but doesn't break above the hourly trigger, you can then buy back the 431 that you sold for cheaper and add to your 433s that you bought. All right, that was a 45-minute session. So any questions, feel free to ask them now. Otherwise, I'm going to close up the stream in a couple of minutes. Thanks for watching, Mr. Clean. You do need margin accounts, yeah, for put spreads and debit spreads. All of it, you need margin. All right, Glad you guys enjoyed. Hope that was helpful. Any questions, you could always leave them in the Bootcamp channel questions. Thanks, was out. See you guys sending the emoji thingies on the chat. I appreciate all of you guys that tuned in live. It's a lot easier to do the videos when I feel like I'm talking to somebody as opposed to, people watching them later. Also, I do notice everybody in here, so, I do appreciate you guys a lot and your willingness to learn. All right, I'm going to close it off here, and any questions, just leave them in the Bootcamp questions channel.